There's a lot of benefits that somebody gets by building business credit. But let's start with the beginning. Keep in mind that when we're building business credit, we're building credit that's in a business's name. So what's happening is the business is building its own credit profile and score for its EIN that's not linked to the business owner's social security number. It's separate. So now they have a consumer credit profile. Now we're establishing a commercial credit profile that's linked to their EIN. And the credit that we're going to get for the business is in the business's name. And it's based on the business's ability to pay, not the business owner. So when we talk about that business credit can be built with regardless of personal credit or without a personal credit check, here's how it's possible. We're building a credit profile and score for the business. The business can then qualify for more credit. The business owner's personal credit's not needed because the business has enough established credit for it to qualify for the credit it gets on its own without needing the business owner to actually intervene. So with an established business credit profile and score, the business then qualifies for additional credit that it can be used, where I basically say it's kind of like the business is funding itself. So think of it like this. We start with vendors like Uline and Quill. We build some initial vendors that establishes trade lines or payment experiences, accounts that report to the business credit reporting agencies. That gives them a business credit profile. How they pay their bills gives them a business credit score. And now with these trade lines that establish a credit profile and the credit score, the business can start qualifying for credit. The more credit it builds, the more credit it can get. So it's a way to build an initial credit profile and score and let the business fund itself. And then the more business credit that's established, the easier it is for the business to then qualify for loans and credit lines as well. Now, don't get me wrong. You never want to try to convince somebody that they're going to get credit lines and loans based on business credit quality alone. That's just not true. For loans and credit lines, some other factors need to be looked at. They'll look at the actual business owner's personal credit in some cases. They'll look at the revenue of the business. They'll look at the profits of the business, right? So when it comes to loans and credit lines, there's other things other than just business credit that lenders are going to look for. But when it comes to business credit cards, somebody can use business credit and business credit alone to qualify. So they can still come in and get a Visa card, a MasterCard, an auto financing for a vehicle. They can come in and get a credit card at almost every major retailer, from Apple to Amazon to Walmart to Sam's Club to Costco to Staples to Office Depot to Lowe's to Home Depot to Macy to Nordstrom, and on and on and on. I mean, you think about a retailer like HP or Dell or Apple, they offer some kind of business credit. So the business credit can be established. The business owner is able to come in and get very high limit revolving business credit cards using the business credit only to qualify. And it helps make them more lendable, because when they go to get credit lines and loans, the lenders are looking at the quality of their business credit to determine three things. Should the person be approved? How much should they be approved for? And what rates and terms should they pay? So if somebody wants to go get a loan and get a credit line, even though the approval is not completely based on business credit quality, the business credit quality will determine if they're approved, will determine how much they get, and will determine the rates and terms that they're actually going to pay. Now, a lot of extra benefits here. We're doubling the business's borrowing ability, or the per individual's borrowing ability, because they already have a consumer credit report. Now we're building a commercial credit report. We're giving them double the borrowing ability because they have two credit reports. They now have consumer, they had consumer, now they have commercial. So think of it like this. You can go to Home Depot today to get a consumer credit card, but you cannot go back to Home Depot tomorrow and get another one. But I can go to Home Depot today and get a consumer credit card, and I can go to Home Depot tomorrow and get a commercial credit card. So it gives them double the borrowing ability because they have consumer and commercial credit. Now, per SBA, the limits on these accounts are 10 to 100 times higher than with consumer credit. So if you're used to getting a $1,000 credit limit now, in the business credit world, you're probably going to get $10,000 to $100,000 credit limits. I know it sounds crazy, but we see business owners get $10,000, $20,000 limits 30 to 60 days into this process. And we see them get $30,000 to $50,000 limits 3 to 6 months into the process. Again, how much they're going to get depends on how they're actually using the credit. You're not going to get a $10,000 credit limit if all you're spending on the credit cards you have is $100. But if you're using business credit to really grow your business, you come in and you get $1,000 credit limit to start at Quill and you use 500 because you really need to buy office supplies and you pay that back. Then you come in and start getting an Amazon account and you spend $3,000 a month on Amazon because you really need the stuff to grow your business. The more you're spending, the higher limits that you will get. It ultimately $30,000, $40,000, $50,000 on the high end on individual accounts. Plus, there's nothing to do with personal credit whatsoever here. So a business owner is able to get approved without affecting their personal credit. So that means that their utilization on their personal credit doesn't matter. Here's why that's important. The number one mistake I see business owners make is they start a business. They think it's going to cost them less money than it will. They put the charges on a personal credit card. Quickly, they max out the personal credit card. And since utilization or what percentage of their high credit limit they're using is 30%, of their consumer credit scores, they tank their personal credit. But not in this case. We're getting business credit that reports to the business credit reporting agencies. So they can max out this credit and not adversely affect their consumer credit whatsoever, because what happens is none of that credit reports on their consumer credit reports. It only reports on their commercial credit reports. Plus, there's no impact on increase on the credit report. Increase could adversely affect their ability to get loans and credit lines. But since there's no increase because there's no personal credit check, then that helps them get business loans and credit lines in the future as well. And they can get it regardless of personal credit quality. I don't care if their credit score is 450 or 500. It doesn't matter because we're not even looking at their personal credit to approve them. They're able to get approved regardless of personal credit checks. And it also can be built very quickly with business credit because your scores are based on how you pay your bills. So consumer credit's based on how long you've had credit for and your credit mix and all these other factors. Business credit's built on only one factor, how you pay your bills. So if we get somebody credit that reports to the business credit reporting agencies and they pay their bills on time or early, they'll get good scores. And that's one of the ways that we can get somebody all the way to the end of the business credit building process in 6 to 9 months. Whereas in consumer credit, it could take you years of well-disciplined borrowing to ever be able to actually get really good credit, but not in the business world because scores are based on how you pay. Now, they're also able to get this without a personal guarantee. No liability. You're not liable for your business debts. What that means is it means if you ever default, they can't come after your personal assets. Look, whenever you personally guarantee something for your business, they're going to come after your personal assets if you default. So let's say you get a business credit line with Bank of America. And then let's say, I don't know, the economy crashes because you're a mortgage broker in the mortgage crisis. And all of a sudden you have no choice but to default on the credit line with Bank of America because you no longer have a business. Now, if you personally guarantee that, the Bank of America can come after your personal assets, like clean out your personal bank account. Let's say you have $5,000 in there and your business is out of business and you don't have a lot of money to survive. You have $3,000 in checks written against the $5,000 in your bank account. And can you imagine coming in and all of a sudden every dime of money that was in your bank account on the personal side is gone because the business debtor came after it? That's what happens when you personally guarantee debt. And by the way, the story I just told you is a true story. It's my story. That exact same thing happened. Bank of America credit line defaulted in the business, mortgage broker, mortgage crisis. They cleaned out my personal bank account as a result. So that's why you don't ever want to supply personal guarantees or personal liability if you don't have to. Business credit you can build without the personal guarantees and liabilities, which means your personal assets are safe if you default on your business debt. Perfect for startup. You don't need revenue to qualify. It's no doc financing. So even if you have no revenue, you're still able to come in and get approved because there's no cash flow requirements. And there's also no collateral requirements. SBA loans, you need to have good credit. You need to have good cash flow. You need to have collateral. You don't need any of that to be able to get approved for business credit. You're able to get approved because there's no collateral requirements. By the way, this is very important. For any kind of loan or credit line, you need what I call one of the 3 C's that you're going to learn about in this training. You need good cash flow or good credit or collateral, one of the 3. Business credit's the only way you can get money for your business without cash flow, without collateral, and without credit. It's a catch-all. Everybody can get it. And it also establishes your credibility because anybody can see your business credit reports. So again, what matters is that if somebody's going to come in and look into your reputation, they're going to pull your business credit reports. If you go to Dun & Bradstreet right now, the first question Dun & Bradstreet asks you is, do you want your own commercial credit report or do you want to pull a report for somebody else? That's why it's so important that you build business credit, because lenders, credit issuers, suppliers, your competitors, your clients, your prospects, anybody can see that. And you also need to know that every company that's successful in this country, the biggest privately owned and publicly owned companies have all built business credit. You cannot show me a successful privately or publicly owned company that doesn't have business credit because they use business credit for their business to fund themselves. Let me give you an example. The biggest retailer in the world is Walmart. 80% of what Walmart sells, they buy on business credit first. So here's how it works. They go and they buy their Bounty paper towels from Bounty using business credit. Then they put those on the shelf. Then they sell them to you and you give them money, and they take your money and they pay off the credit they used to buy the paper towels. 80% of what Walmart sells is done that way. They use business credit to be able to buy the stuff to put on their shelves. They use your money to pay off the credit. It's how they become the number one retailer in the world. Pretty smart, huh? They have more money into their business from business credit than all shareholder value combined. That's mastering OPM, other people's money. It's how you become successful, is you use other people's money to grow. And every successful company in this country, privately and publicly owned, has used business credit to get where they are. But here's the kicker. Even small companies can ride the coattails, do exactly the same thing, follow the same methodology these big companies use to build their business credit, and have the ability to be highly successful like the biggest players are, using the same methods they used by building business credit. So as I mentioned, a lot of benefits that you want to know about when you're talking about business credit to your clients. But as you can see, this is a phenomenal asset that any business owner can have to be able to get financing for their business, even when they can't get any other kind of financing, to build their credibility, to get away from personal guarantees, to separate consumer and commercial credit, and access very high limit accounts without revolving or without personal credit checks and without personal guarantees.